Hi, Dean Jenkins with FollowMeTrades.com for the week coming up of September 28th. It was a pretty exciting week last week, lots of volatility. The week before last, we had talked about the Fed making an announcement, a decision on September 17th about not raising interest rates. And last week I said we were likely to get some volatility this last week, starting Thursday, Friday when the jobless claims and the GDP report came out. Well, we certainly had that, and it even started a little bit earlier. And I think we can look forward to some more volatility this week and even beyond. But let's take a look at the headlines and see what's going on. So the first really big headline from last week was on the 24th, Janet Yellen expects interest rates to increase this year. Remember on the 17th, she had said we're not raising interest rates at this time in September. And this last week she clarified, but we are going to be raising them this year. We do expect to raise them sometime this year. And again, their objective, they're watching the labor market. They want to not interrupt the improvement in the labor market, and they also want to control inflation. They're expecting inflation to take off, and they're using interest rates to control that so it doesn't grow out of control. Inflation, runaway inflation is really bad, and they're trying to keep that at around 2%. So they raise interest rates in anticipation of economic growth to keep inflation under control. So what this ends up doing is creating this situation where sometimes good news is bad news. For example, investors and analysts are looking at the jobless claims, the employment situation, and if jobless claims go down, meaning less people lose their jobs and claim unemployment benefits, then they think, which is good news, right? That's good news. Less people losing their jobs, but they think, well, that'll make the Fed raise interest rates faster and raise them more. This kind of good news equals bad news. This can make your head spin. And that's why looking at the charts and the reality versus trying to make decisions off of the headlines is so important. The markets, the charts represent the reality of how all the information that's coming in is interpreted and acted on by investors. Charts show a picture of the collective investor optimism and pessimism, and those outlooks of optimism, pessimism definitely move in waves and cycles, and we can see that on the charts. And what we see on the charts, how people are processing the information and responding to it, that's the reality. And that's what we try and make trading and investing decisions on. So the next big headline this week, if you're following the news, this is no surprise. The headline is what to expect in the post-John Boehner world. So as you know, Speaker of the House John Boehner on Friday resigned unexpectedly. And that caused some volatility in the markets. And the markets actually ended up they were going up and then they went down a little bit and closed pretty close to zero after all of that was said and done. What this really is about in the short term is, the government's fiscal year ends at the end of September. The new fiscal year begins on Thursday, October 1st, and Congress hasn't passed a budget in years, so we don't have a budget. They need to pass a bill, a temporary spending bill, to keep the government open starting Thursday, October 1st. With John Boehner resigning effective the end of October, there's every expectation that he and some of the Congress will back down on some of the ideological stances they had around funding Planned Parenthood and stuff like that, and that they would pass a spending bill and the government will stay open. And they're passing a bill, they expect to pass a bill that goes out into December so that we can have the fight again and more volatility then. But that's really that's a big deal, and we can watch that coming up this week. So Congress needs to pass that bill to fund the government before the new fiscal year starts on Thursday, October 1st. The markets are expecting that to happen. If that gets threatened, if there's any kind of positioning and whatnot that would put that at risk, that's going to cause some really extreme volatility. So that's something to watch, that the bill gets passed and the government gets funded. And the next thing, there's a few economic reports coming up next week, but the real big ones are on Thursday, the jobless claims, and on Friday, the employment situation. Again, investors and analysts looking at that information and trying to guess what the Fed's going to do with that information and when they would raise interest rates and by how much. Again, that's a mind-numbing, head-spinning exercise to try and guess what people are going to do. That's why we just take a look at the reality of the charts and act on that. Before we get into the charts, I want to look at one quick website that just shows a sector breakdown of the S&P 500, and then we will get to the charts. This is a web page, sectorspider.com, that shows the performance of the 9 sectors that make up the S&P 500 index. And this is looking back at the last 3 months. And you can see, I've been talking about having a bearish outlook on the market. And this shows that pretty clearly, that 8 out of the 9 sectors that make up the S&P 500 are in negative territory over the last 3 months. Some of them pretty deep. Materials down 18.92% in the last 3 months. Energy down 17.5%. Healthcare 12.12%. I expect this to continue. This is just kind of confirming the fact that I believe, my analysis shows that we're in a bear market. The market's going down, and you can see all these sectors are down as well. The only one that's up just a little bit is utilities. We're looking at the Dow Industrial Average chart here. This is on a weekly basis, so every price bar represents a week. And as I've been saying, I believe we're in a bear market. That's what the reality is, and that our price targets where this thing will go are down here, 14,429 to 12,003. Somewhere in here is where this downtrend is likely to go. So I've switched now to a daily chart. We'll just zoom in on this a little bit. And there's something interesting going on. You see this red trend line that I've drawn here, this diagonal line. That's called a trend line. And this represents this current downtrend that we are in. And there's a couple things that could happen here. I talked in a previous update in the last couple of weeks about the phenomena known as an ABC pattern, that in a downtrend there's quite often an ABC pattern. And it could be, this is the A, this is the B, and then C goes on down into the target zones. It doesn't go that smoothly, but that could be what happens. And we could stay under this red trend line. And if over the next few weeks, if we do end up going down under this trend line, then that's what's going on. But there's another scenario that could say, this is all A. It's all just been kind of smoothed out, and that we have a B coming and then a C. So if we get above this red trend line over the next few weeks, then that's really what's going on, that we're going to go back up. I don't think we'll get above this green line here, but it could be that the ABC is just a little longer in duration. We don't really know. Again, we have some real volatility coming as the political landscape plays out, as the economic reports come in, and we'll just keep an eye on it. But what's clear to me, I'm not sure, where the ABC pattern is going to fall, or whether it's going to even be that clear. But what is clear is that we are in a bear market, in a downtrend. I'm convinced we're going down to those target zones that I talked about, and we'll just have to see how the news plays out. So stay tuned. We will continue to provide updates. Some of the big deals coming up: Congress passing a bill to fund the government, the economic reports. That's all there. And again, what do you do with this information? I'm publishing stock picks, and taking advantage of this information, and we're really profitable with those picks. Just staying tuned to the reality and trading in accordance with that. And if you're not sure, if more active trading isn't your thing, like I said last week, you may consider just moving to cash. Moving out of index mutual funds, stock mutual funds, or whatever you're in, and going to a money market fund. Making close to 0% return on your money, in my opinion, is better than losing 10, 20, 30%. Not your financial advisor. I don't know your situation, but that's what I am doing, and what that's what I would recommend people do if you don't want to sit through a big correction and lose money. That's your choice. But stay tuned. I will continue to provide updates. It won't be boring. There's a lot coming, and we'll see how it plays out. We'll see what the real reality is. Thanks.